Imagine building this massive, I don't know, financial empire where the CEO is literally just an immutable piece of code.
Right.
And the shareholders, they're just anonymous global wallets. And all the assets can just vanish forever if someone loses, like a random string of cryptographic text.
It's terrifying when you really think about it.
It is. But for over a decade, that was the exhilarating and honestly terrifying reality of the crypto frontier. I mean, you struck gold, you protected your own claim, and the sheriff was usually just, well, whoever had the most hash power on the network.
Exactly. It was the Wild West.
But now, imagine trying to actually regulate that. Imagine trying to take a master-planned, heavily institutional grid and just drop it right on top of that Wild West.
That's a massive undertaking.
It's huge. And that is exactly what we are looking at today in the Emirate of Dubai. Welcome to the deep dive. Today we are unpacking a foundational document that's essentially shaping the future of global finance for you, the listener.
Yeah, we are really witnessing the absolute definition of a paradigm shift here.
We really are.
I mean, we're moving from this historically trustless ethos, where quote-unquote code is law,
Right.
to this heavily mandated state-backed framework of institutional trust. And it's happening at just a breathtaking pace. What we're looking at today stems from Law Number 4 of 2022.
Okay, so that's the law that actually established the Virtual Assets Regulatory Authority,
Yeah.
right? Or VARA, as we'll call them.
Exactly, VARA.
Mm-hmm.
But for this deep dive, we aren't just skimming that surface legislation. We are going straight into the engine room.
I love that.
We are unpacking VARA's compliance and risk management rulebook. And specifically, we're looking at the iteration dated the 19th of May, 2025.
Right. And to really ground this entirely in reality, I think we need to define who this actually targets, right? Because there's a main character in this whole regulatory architecture.
There is, yeah, the VASP.
The VASP, the Virtual Asset Service Provider. So if you are listening to this and you're operating an exchange or, say, providing custody for digital wallets or acting as a broker-dealer in the Web3 space within Dubai, you are a VASP.
And this specific rulebook we're discussing, it's the operational bedrock you absolutely must build your company on.
Yeah, exactly. Our mission today is to translate this incredibly dense legal text into the practical day-to-day reality of running a virtual asset business.
Because it is dense.
Oh, it's a brick. We're going to look at the operational friction, the mathematical requirements, and frankly, the profound legal liabilities that founders, compliance officers, and developers now face.
And I think it helps to understand the underlying philosophy of this entire document first.
Okay, yeah, lay it out for us.
Well, the core theme here is consumer protection, right? And the absolute prevention of financial crime.
Yeah.
I mean, for years, the broader tech industry operated on that famous mantra of move fast and break things.
Right, the classic Silicon Valley playbook.
Exactly. And if, say, a Web2 company violated a data privacy regulation, what did they do?
They just paid the fine.
Right. They often just treated the resulting fine as a simple operational expense, just the cost of doing business.
Yeah, a slap on the wrist.
But this rulebook systematically dismantles that approach.
That's right.
VARE is making it unequivocally clear that compliance is not just some afterthought handled by a siloed legal team in the basement.
Right.
Compliance is the core functionality of the business now.
Okay, let's unpack this, because that's a huge shift. So let's look at how a VASP actually constructs that functionality in practice. VARE mandates this foundational framework called the Compliance Management System, or the CMS.
Yes, the CMS.
And the language they use in the rulebook here is very deliberate. They require VASPs to act with, quote, diligence reasonably expected of a VASP of a similar nature.
That wording is so critical.
Right, because in a space where there historically were just no standards at all, this creates a massive comparative legal hook.
Exactly.
I mean, if a platform gets exploited, VAI can literally look at the wider market, point to a competitor's security practices, and basically say, hey, they wouldn't have made that error, therefore you lack diligence.
That's spot on. That comparative standard effectively forces the entire industry to constantly elevate its baseline. You just cannot afford to lag behind industry best practices anymore.
Because those best practices effectively become the unwritten law.
Precisely. But the CMS itself, the actual system, is the physical manifestation of this diligence. It requires, and they stress this, unfettered access to all necessary records and documentation by the board and relevant staff.
Wait, unfettered, so no hiding behind, like, oh, this is proprietary tech.
No hiding at all.
Yeah.
If the compliance department needs to review, say, a specific transaction log, or even a developer's smart contract deployment history, the engineering team cannot hide behind claims of proprietary code
Wow.
or restricted access. The visibility must be total.
Okay, and at the center of all that total visibility is the compliance officer, right? The CO.
Yes, the CO.
Hmm.
And VARA demands a CO who is independent, experienced, and fiercely empowered.
I kept thinking of an analogy for this when I was reading the source material. If we look at traditional high-frequency trading firms, right, they use these algorithmic circuit breakers.
Oh, right, the kill switches.
Yeah, exactly. If a trading algorithm starts acting erratically and like blowing past its risk thresholds, this circuit breaker mathematically just halts the entire trading engine before the firm goes bankrupt.
Right, it saves the firm from itself.
Exactly. And reading this rulebook, the CATO in a Dubai VASP is designed to be the human equivalent of that circuit breaker.
That is a perfect way to look at it.
They administer the CMS, they're responsible for training the C-suite, which is wild, and they carry this massive statutory burden.
Oh, the reporting burden is immense.
Right. They are legally bound to notify VAA directly of any material noncompliance by the VASP, its board, or its staff.
And you really have to consider the corporate dynamics of that mandate.
Oh, it's fascinating.
The compliance officer is hired and paid by the CEO of the startup, right?
Yeah, they're an employee.
But they possess a direct, legally protected reporting line straight to the government regulator.
That has to create some awkward board meetings.
Seriously. I mean, if the executive team decides to push a really high-risk product launch that maybe skirts the edge of the regulatory perimeter, the CEO has the absolute authority and the legal obligation to blow the whistle.
They have to.
Yeah, it elevates compliance from a purely advisory role, like it used to be, to an active executive-level governance mechanism.
But okay, let me push back on this a little bit. Let me present a scenario from the perspective of a Web3 founder.
Okay, let's hear it.
The entire competitive advantage of decentralized technology is speed, right? Rapid iteration.
Historically, yes.
So if my engineering team wants to integrate a hot new DeFi protocol and my compliance officer has to perform this exhaustive audit because they have unfettered access and the literal power to halt the launch, that introduces massive operational drag.
It does?
So doesn't this heavy-handed institutional-grade compliance inherently crush the agile innovation that built the crypto sector in the first place?
Well, here is the harsh truth for founders. That operational friction is entirely intentional.
Really? It's a feature, not a bug.
Absolutely. I mean, regulators have watched billions of dollars just evaporate overnight precisely because companies optimized for speed over stability.
Oh, yeah. 2022 was a bloodbath.
Right. So the friction introduced by the CO and the CMS, it's deliberately designed to prevent catastrophic systemic failure. Furthermore, the rulebook institutionalizes memory.
What do you mean by that?
VASPs are required to maintain pristine books and records for a minimum of 8 years.
8 years. In crypto, 8 years is like a century.
It's an absolute eternity. And those records have to be stored in their native file formats and readily available for immediate audit.
And it isn't just passive storage either, right? They have to actively submit quarterly reports to VARA, detailing everything from board meeting minutes to strategic business plans.
Yeah, the regulator is embedding itself directly into the governance loop.
It's intense. But, you know, recording historical data is really only valuable if you actually use it to predict future failures, which logically brings us to the next section. How VAR expects these companies to diagnose threats before they happen.
Right, the 4 pillars of risk management.
Exactly, because a VASP can't just react to a crisis anymore. They are required to proactively model out worst-case scenarios across multiple vectors.
And again, the rulebook demands a comprehensive, quantitative risk management framework.
Quantitative, not just good vibes.
Right, no good vibes. Qualitative assurances like simply stating in a PowerPoint deck that the company will monitor volatility that is entirely insufficient for VR.
They want the hard math.
They require mathematical rigor. For example, when evaluating the impact of changing market conditions, VASPs must establish quantitative measures to assess the risk of, quote, unspecified adverse market movements.
Okay, so let me break that down. Like, they have to run value-at-risk models against their treasury.
Yes, their treasury and their clients' virtual asset holdings. They have to prove mathematically that their ship can survive a sudden liquidity crunch or a black swan pricing event.
So it's like building a ship, right? Making sure the hull doesn't leak is one thing, but this is like proving the ship can survive a Category 5 hurricane before you even put it in the water.
Exactly. You can't just guess it will float.
So if a token flash crashes by 80% in an hour, which, let's be honest, happens in crypto,
All the time.
the VASP already needs to have the math proving their solvency won't break.
That's the market risk pillar.
But what about the entities they interact with? Because decentralized finance is fundamentally built on composability, right? Plugging different protocols and institutions together like Legos.
Right, the money Legos.
So if a VASP is extending credit, or, say, waiting for a massive block trade to settle with an offshore counterparty, how does VAR expect them to measure that exposure?
Well, that falls under the mandate to monitor and quantify credit and counterparty risk.
Oh.
A VASP absolutely cannot rely on a counterparty's reputation or even the perceived immutability of a smart contract.
So a blue check mark on Twitter isn't enough due diligence anymore.
Sadly, no. They must utilize external credit assessments or develop really robust internal rating methodologies to set hard trading and position limits.
Oh, wow.
Yeah, and if counterparties' internal risk score degrades for any reason, the VASP systems must automatically restrict exposure to that entity.
Okay, so that covers external market shocks and shady counterparties. But what happens when the failure is closer to home?
You mean operational risk?
Yeah. Let's say a VASP relies on a third-party cloud provider for their matching engine, right? Or they use an external Oracle network to feed price data into their systems, and that vendor gets compromised.
That's a great example, and under this framework, the liability does not magically transfer to the vendor.
Wait, really? The VASP is still on the hook?
The VASP retains the ultimate operational risk. If an external Oracle is manipulated, or let's say an employee falls for a spear phishing attack that compromises a hot wallet.
Oh, the classic phishing link.
Exactly. VRA views that as a fundamental failure of the VASP's internal controls, not just a vendor issue.
Sure. Man, they do not mess around.
They don't. They explicitly require risk assessments regarding the development and deployment of new technologies, ensuring that technical debt doesn't just metastasize into a critical security vulnerability.
They also heavily focus on consumer protection risk, right? I noticed they enforce strict boundaries on financial promotions.
Oh, absolutely.
Basically to prevent misleading marketing regarding yield or asset safety. No more promising 20% risk-free APY on a billboard.
Exactly. But, there's a very specific technological risk vector highlighted in this framework that I think is just fascinating.
Yeah, sure.
The rulebook explicitly mandates that VASPs must assess the risks related to, quote, anonymity-enhanced cryptocurrencies and the methodologies by which anonymity-enhanced transactions can be conducted.
Okay, that is super interesting because it reveals VR's deep technical fluency. They are not merely legislating Bitcoin or Ethereum here. They are aggressively targeting privacy-preserving technologies.
Yes, the cutting edge of crypto tech.
Right. We're talking about assets that utilize ring signatures or stealth addresses or zero-knowledge, succinct, non-interactive arguments of knowledge.
Better known as ZK-Snarks.
Thank you, ZK-Snarks. Try saying that 3 times fast. But by specifically highlighting these anonymity-enhanced networks, VARA is laying down a serious marker.
They really are. They're basically saying if a VASP chooses to interact with cryptographic protocols that are designed to obfuscate the transaction graph, their compliance burden and required risk multipliers will just scale exponentially.
Which logically forces a massive pivot in how a VASP operates, right? I mean, if privacy-preserving cryptography breaks your quantitative risk models, how do you actively filter out illicit actors before they pollute your platform?
And that requires an entirely different set of operational mechanics.
Yeah, you essentially transition from managing abstract market volatility to directly confronting financial crime. Which brings us perfectly to the front lines, AML and CFT.
Right. Anti-money laundering and combating the financing of terrorism.
Exactly. This is where the regulatory framework maps traditional finance standards directly onto decentralized architecture. And the linchpin of this entire defense system is the MLRO.
The Money Laundering Reporting Officer.
Right. Now, earlier we talked about the compliance officer who oversees the broad regulatory framework, but the MLRO is the specialized, heavily scrutinized gatekeeper specifically tasked with preventing illicit capital flows.
What's fascinating here is the sheer technical pressure placed on the MLRO. It is immense.
It sounds like the hardest job in the building.
It might be.
Yeah.
They are required to utilize a highly specific electronic platform called GoAML.
GoAML. Okay.
Yes. They use it to submit suspicious transaction reports directly to the UAE Financial Intelligence Unit.
Okay, but here's my question. Traditional finance AML relies on legacy identity verification, right?
Sure.
You walk into a bank branch, you present a passport, you give them a utility bill to prove your address.
Very straightforward.
Right. But the MLRO at a crypto exchange, they are staring at alphanumeric wallet addresses interacting with decentralized protocols. So how do they bridge that gap?
Well, VARA enforces aggressive client due diligence, or CDD. The VASP literally has to pierce the veil of the blockchain to uncover the true identity of the ultimate beneficial owners.
The UBOs.
Right, the UBOs. This concept is foundational to global AML laws. You must know who actually controls the capital.
Makes sense.
But VARA introduces a profound legal precedent here by explicitly addressing decentralized autonomous organizations.
DAOs.
Yes. The rulebook dictates that if a client's corporate structure includes a DAO, the VASP must exhaustively investigate its intended purpose and control structure.
Wow. This is where the whole philosophy of code is law violently collides with compliance is code.
It really is a collision.
Let's game out a scenario to show how difficult this actually is for developers and compliance teams.
Okay, let's do it.
Imagine you are the MLRO at a major Dubai-based exchange. A new corporate entity applies for an institutional trading account. Your onboarding team begins the due diligence and discovers this entity is wholly governed by a DAO based in some offshore jurisdiction. The DAO's treasury is controlled by a multi-signature wallet, and the actual decisions are made by, say, 10,000 anonymous wallets holding governance tokens, voting on a snapshot protocol.
A nightmare for compliance.
Right. How do you possibly execute a background check on a diffuse piece of global code governed by 1,000 anonymous people?
Well, to a traditional compliance framework, that structure is a massive flashing red flag.
Oh, I bet.
The MLRO's automated risk systems would immediately mandate enhanced due diligence. They cannot simply accept the decentralized nature of the entity as an excuse for anonymity.
So what do they actually do?
They would be forced to analyze the token distribution on the Block Explorer. They have to ask, are we dealing with genuine decentralization here? Or is there a concentration of governance tokens in 3 or 4 massive wallets that effectively wield veto power over the entire protocol?
Oh, I see.
Right. And if those whale wallets exist, VARA views them as the de facto UBOs.
Wait, really? So,
Yeah.
okay, what if the corporate entity refuses to provide cryptographic proof of identity for those massive wallet holders? Like, what if they cite the privacy ethos of Web3 and just say no?
Then the MLRO has no choice. Utilizing their mandated authority, they must block the onboarding entirely.
Just flat out rejected.
Flat out. And if this obfuscation happens with an existing client, say, someone who suddenly receives a massive influx of capital from a decentralized mixer.
Like Tornado Cash or something.
Exactly. The MLRO must freeze the assets, file a report through that Gallia ML system to the Federal Intelligence Unit, and crucially, and this is very important, navigate the strict legal prohibition against tipping off the client.
Oh, right. The no tipping off rule. You can't let them know they are under federal investigation.
Exactly. You have to freeze it and act like everything is normal on the front end.
That is wild. And to ensure this whole defense system doesn't just, atrophy over time, the VASP's AML policies must be attested by a competent third party, right?
Yes.
And submitted to VARA within 21 days of any internal policy change, meaning you cannot silently degrade your security posture to save a few bucks.
You absolutely cannot. But, locking down your own platform is really only one piece of the puzzle here.
Right, because crypto moves.
Exactly. The true complexity arises when the capital actually moves. When a user withdraws their assets from a Dubai VASP to an external platform, well, the regulation follows the money.
Here's where it gets really interesting.
It does.
Because we were talking about the FATF travel rule.
Yes, the Financial Action Task Force.
Right. And as mandated by VARA, the travel rule fundamentally attempts to force borderless pseudonymous blockchain networks to essentially adopt the messaging architecture of the traditional SWIFT banking system.
That's exactly what it is.
And VAR explicitly mandates that for any virtual asset transfer exceeding AED 4,000, which is roughly, a little over $1,000 US.
Yeah, right around there.
For any transfer above that threshold, the VASP must securely transmit specific personal identifying information alongside the transaction.
And this requires a massive technical leap for these companies.
Mm-hmm.
I mean, think about it. The base layers of Bitcoin or Ethereum, They were mathematically designed to process value transfers without attaching personal data.
Right. Satoshi Nakamoto didn't include a first name, last name field in the Bitcoin protocol.
Exactly. So if a VASP in Dubai is facilitating a withdrawal to an exchange in London, they can't just broadcast the transaction to the public mempool and be done with it.
No.
They have to utilize off-chain software protocols, things like TRP or IVMS 101 messaging standards, to securely encrypt and transmit the originator's name and wallet address, alongside the beneficiary's data, to the receiving institution.
While simultaneously settling the actual asset transfer on the public ledger.
Yes. The synchronization of off-chain identity data with on-chain settlement is just a staggering engineering challenge.
It sounds incredibly fragile.
It is complex, but VAR compounds this by placing the burden of institutional trust squarely on the Dubai VASP.
What do you mean?
Well, before a VASP can even facilitate that transfer to the London exchange, they are required to conduct risk-based due diligence on the receiving institution.
Wait. Let's unpack the implications of that.
Sure.
If I'm running a licensed exchange in Dubai and my retail customer just wants to withdraw their own Bitcoin to an exchange in a jurisdiction with lax regulations, let's say a newly launched platform in South America somewhere, VAR is telling me I have to audit the South American platform's compliance stack before I authorize my customer's withdrawal. That's insane.
The regulation demands that you determine the regulatory safety of the destination. You cannot blindly blast assets into a regulatory black hole simply because the customer requested it.
Wow.
And this dynamic creates what the industry refers to as the sunrise issue.
The sunrise issue, I've had this term, it's essentially the reality that the regulatory sun is rising at drastically different times across the globe. Right?
That's a great way to visualize it.
So Dubai is in full daylight, implementing strict FATF standards. But what happens when that South American exchange is still in the regulatory dark?
Right.
Like, they might reply to the Dubai VASP and literally say, hey, we don't have the off-chain software to receive your encrypted customer data, and our local laws don't even require us to collect it anyway. Just send the Bitcoin.
And this is where the regulatory framework effectively deputizes the Dubai VASP.
Deputizes them.
Yeah. The rulebook explicitly demands that VASPs maintain a documented operational plan to handle transactions with non-compliant jurisdictions.
So what does that look like in practice?
In practice, this often forces the Dubai institution to manually intervene. They might require the customer to cryptographically sign a message proving ownership of the unhosted destination wallet.
But the Satoshi test.
Exactly. Or, in high-risk scenarios, the VASP must simply sever connectivity, blocking the transfer entirely to protect their own VARA license.
So if we're in the daylight and the receiving country is in the dark, the chain just breaks.
Exactly, the chain breaks.
By enforcing these sunrise protocols, VARA isn't just regulating activity within the Emirate of Dubai. They are forcing Dubai-licensed companies to project UAE compliance standards outward. They're acting as global enforcers.
That's exactly what's happening. It organically constructs a walled garden of compliant, interoperable global institutions.
Wow. So if an offshore entity refuses to adopt FATF standards, Dubai capital simply cannot flow to them.
It is the systemic isolation of non-compliant liquidity.
That is massive.
It is. And while tracking the movement of assets is obviously critical for preventing crime, the regulator applies an equally rigorous standard to how the VASP protects the legitimate assets that remain stationary on the platform.
Okay, yes. This is crucial for everyday users.
Exactly. And the methodology for safeguarding client capital here is bifurcated into two distinct regimes.
Which are?
The treatment of traditional fiat currency and the cryptographic management of the virtual assets themselves.
All right, let's examine the fiat architecture first, which VARA designates as the client money rules. And from what I read, the foundational principle here is the absolute prohibition of commingling.
Absolutely no commingling.
VARA defines client money as any fiat currency held by the VASP on behalf of a client, strictly excluding operational capital or fees immediately due to the platform.
And the operational velocity demanded here is intense.
Yeah, talk to me about the one-day rule.
VAR enforces a strict one-day rule. When a client deposits fiat, that capital absolutely cannot sit in the VASP's operational treasury account.
Not even for a weekend.
No. It must be routed into a fully segregated client account within 1 calendar day of receipt.
See, that stood out to me. Notice they specify 1 calendar day, not 1 business day.
That distinction is huge.
It is, because if a massive wire transfer lands on a Saturday during some volatile market event, the VASP's finance operations team cannot just wait until traditional banking hours on Monday to separate the funds.
Right.
They must have the banking infrastructure to segregate that capital immediately.
Yes, and furthermore, for UAE-based clients, that capital must reside in a third-party bank that is legally domiciled within the UAE. For non-UAE clients, they can use banks in other FATF-compliant jurisdictions.
So the geography of the banking partner matters immensely for jurisdictional control.
It does. But the core legal mechanic at play here is insolvency protection.
Bankruptcy.
Right. The rulebook dictates that VASPs shall not take ownership of client money under any circumstances, barring highly specific regulated trust structures.
It's like the ultimate cookie jar analogy, right? You can't put your kid's allowance in your own wallet to pay for your groceries, even if you promise to put it back later when you get paid.
That's a perfect analogy.
By denying the VASP legal ownership of the fiat, VARA is engineering a bankruptcy remote environment.
Exactly.
And to really understand why this matters to the listener, we only have to look back at the catastrophic failure of platforms like Celsius.
A painful memory for many.
Truly. When Celsius collapsed, the bankruptcy courts ultimately determined that because the user agreements actually transferred ownership of the deposited assets to the platform,
Which nobody read, by the way.
of course not, but because of that fine print, the retail users were legally classified as merely unsecured creditors.
Tragic.
Their life savings were just swallowed by the bankruptcy estate to pay off the company's institutional debts. It was brutal.
It was. But VAA's mandate creates a firebreak against exactly that. Because the VASP never legally owns the fiat under these rules, if the VASP goes bankrupt, the client funds are theoretically ring-fenced from the creditors.
It guarantees that customer deposits cannot be utilized as operational liquidity.
Right. And to enforce this barrier, VAR requires relentless mathematical proof.
More math.
Always more math. VASPs must execute internal reconciliations of client money balances at least daily. They have to check their internal ledger against those segregated accounts.
Daily. Wow.
And moreover, they must reconcile against external third-party bank statements at least monthly.
Wait, so how does that work in practice? What if there's a discrepancy?
Well, if a discrepancy occurs, say the platform's ledger shows more fiat liabilities than what actually exists in the bank account.
Uh-oh.
Yeah, big problem. The VASP must instantly inject its own operational capital to cover the shortfall.
Wow. They have to plug the hole with their own money immediately.
Immediately.
The transparency is absolute, down to the requirement of sending monthly statements to clients detailing every single credit and debit.
It's basically traditional banking hygiene.
Right, but routing traditional fiat through regulated banking channels is, an old science. The profoundly complex challenge is applying that exact same standard of segregation and insolvency protection to programmable cryptographic assets.
And this leads us to the client virtual assets rules.
Exactly. Guarding the crypto itself.
If we connect this to the bigger picture, the philosophy completely mirrors the fiat regulations, but the implementation requires incredibly sophisticated blockchain architecture.
Because crypto isn't sitting in a bank vault.
Exactly. So a client virtual asset is defined as any digital asset owned by the user where the VASP actually controls the private keys or the seed phrase.
Okay, standard custodial setup.
Right. And the primary directive here is the client VA wallet rule. The virtual assets must be cryptographically segregated from the VASP's proprietary treasury, clearly labeled in all books and records.
But the true centerpiece of this section, the rule that fundamentally alters the business models of legacy crypto exchanges, is the absolute ban on unauthorized rehypothecation.
This is massive.
The rulebook explicitly states that a VASP must hold client virtual assets on a strict one-to-one basis.
Yes, and we need to explain why this matters. Rehypothecation was basically the hidden engine of the 2022 crypto credit contagion.
It was the disease that infected everyone.
It was. Major institutions would take retail deposits, Bitcoin, Ethereum, stablecoins, and they would secretly lend them out.
Right, to massive hedge funds like Three Arrows Capital.
Exactly, to generate yield, or they'd use them as collateral to leverage their own proprietary trading desks.
And when the market contracted...
When the market contracted and the hedge funds defaulted, the assets just vanished. The retail users attempted to withdraw, only to find the platform was hopelessly insolvent.
It's like a valet parking service, right? They hold your keys, but they absolutely cannot rent your car out to an Uber driver while you eat dinner.
I love that analogy. That's exactly it.
VARA's one-to-one mandate makes that shadow banking model highly illegal in Dubai. If 1 million retail users deposit 1 Bitcoin each, the VASP must hold exactly 1 million Bitcoin in verifiable cold or hot storage.
Period.
They cannot lend it, they cannot stake it, they cannot touch it without explicit, discretionary, and prior consent from the client.
Again, the regulator does not operate on trust.
Of course not.
They demand cryptographic verification. VASPs are required to generate proof of reserves, supported by independent third-party audits.
So they have to show the receipts on-chain.
Exactly. This often involves constructing Merkle trees.
Merkle trees?
Yeah, they're cryptographic data structures. Basically, they allow anyone to mathematically verify that their specific account balance is actually included in the platform's total liabilities, and that the platform's on-chain wallet addresses actually hold enough assets to cover those liabilities.
That sounds like an operational nightmare, honestly.
It is a massive technical burden.
I mean, executing daily reconciliations for virtual assets. You are taking highly volatile assets operating across dozens of different Layer 1 and Layer 2 blockchains, constantly fluctuating with gas fees and network congestion, and you're mathematically proving solvency every 24 hours. That is intense. But wait. There is a secondary rule buried in this section that establishes a massive legal precedent regarding network-generated yield.
Ah, yes. You were referring to the treatment of proceeds.
Yes.
Airdrops.
Right. The framework explicitly decrees that all proceeds related to client virtual assets, and they specifically cite airdrops and staking gains belong entirely to the client by default.
This dismantles a major historical revenue stream for exchanges.
It really does.
I mean, in previous market cycles, when a decentralized protocol executed an airdrop, distributing millions of dollars of newly minted governance tokens to active wallet addresses, exchanges holding customer assets would often receive massive allocations.
Huge windfalls.
And many platforms simply absorbed those tokens into their own treasury as pure profit. They just argued, well, the users didn't hold the private keys, we did.
But VARA has legally defined those network rewards as client property now.
That shapes the whole business model. It forces the industry to mature. If you want to operate a VASP under VARA's jurisdiction, you must compete on the actual quality of your custody tech, the speed of your matching engine, and the transparency of your fee structure.
Right. You can't just secretly skim off the top.
Exactly.
Yeah.
You cannot rely on secret leverage or the silent expropriation of network rewards to pad your balance sheet.
Okay, but let's take a step back and look at the sheer weight of this entire compliance infrastructure we've talked about.
It's heavy.
It's crushing. Maintaining a highly empowered CMS, utilizing advanced algorithmic risk models, funding an MLRO team to track global capital flows via Go AML, executing daily cryptographic proof of reserves, managing segregated fiat banking relationships.
It adds up.
The barrier to entry for a lean Web3 startup seems virtually insurmountable. It requires immense capitalization just to keep the lights on and pay the compliance team.
That's a very valid concern.
So how does the ecosystem maintain innovation if only massive legacy institutions can actually afford the compliance overhead? Doesn't this just kill the startup vibe in Dubai?
Well, VARA actually engineered a specific structural solution to address that exact friction.
Oh, really?
Yes. Which brings us to the architecture of sponsored VASPs.
Ah, the umbrella effect.
Exactly. This allows for complex corporate incubation while maintaining a rigid chain of regulatory accountability.
Okay, so the framework defines a regulated sponsor, which is a massive, well-capitalized entity that has successfully navigated the full VARA licensing process. And then there's a sponsored VASP, which is a smaller entity operating under the sponsor's regulatory umbrella.
Right. But we need to be clear. This isn't some loose, informal partnership. The rules demand a shared controlling entity. They must be structurally and legally bound together.
And what's the mechanism driving this?
The centralization of liability.
The ultimate responsibility.
Yes. The regulated sponsor assumes total, unequivocal responsibility for the sponsored VASP's compliance across every single rulebook. We're talking technology, market conduct, risk management, everything.
So to VARA, there's only one throat to choke.
Only one. If the sponsored VASP experiences a critical security breach, or say they fail to execute a proper AML investigation, the regulator brings the hammer down on their regulated sponsor's master license.
Wait, then why would any sane corporate board take on that massive existential liability. It's like co-signing a mortgage for 5 different teenagers.
That's hilarious, but yeah, it's a huge risk.
If the sponsored entity makes a fatal error, the sponsor's entire global business could be threatened by regulatory action.
True, but it is entirely about strategic corporate structuring and risk ring-fencing.
How so?
Imagine a major global exchange entering the Dubai market. They might establish one primary regulated sponsor entity. Then they can isolate their specific, riskier business lines, like maybe spinning out an experimental decentralized derivatives platform, or a bespoke institutional custody solution, or even an NFT marketplace as individual-sponsored VASP.
Oh, I get it. This structure allows them to isolate the operational risk of a new product launch while centralizing the immensely expensive compliance, legal, and risk management overhead at the sponsor level.
Exactly. It's highly efficient for large corporations.
Yeah.
But the segregation of data remains absolute.
Right, to prevent contagion.
Yes. The sponsor must maintain completely separate banking rails for each sponsored VASP. The underlying code and the user's personal data cannot be commingled across the different entities.
That makes sense.
Furthermore, to prevent consumer deception, the sponsored VASP must explicitly state in all its marketing materials that it operates under the sponsor's license.
So full public disclosure.
Full transparency to the market regarding who actually holds the ultimate liability.
It represents a highly sophisticated method of fostering a localized, dynamic tech ecosystem,
Yeah,
without diluting the strict safety mandates of the core rulebook.
it really does. It balances innovation with safety.
Well, we have journeyed incredibly deep into the mechanical reality of the VAR framework today.
It's a lot to process.
It is. So to synthesize everything we've uncovered for you, the listener, the key takeaways here represent profound paradigm shifts.
Absolutely.
For the founders and the C-suite listening, the era of treating compliance as a secondary legal function is completely over. Compliance is now your central nervous system. It is the algorithmic circuit breaker that dictates your absolute speed limit.
And for the technical architects and the developers out there, the demands have shifted from merely deploying efficient smart contracts to building institutional-grade, globally interoperable infrastructure.
You literally have to build bridges to the legacy world.
You are tasked with seamlessly marrying off-chain encrypted messaging for the travel rule with the daily on-chain cryptographic reconciliation of segregated assets. It's a monumental engineering task.
And finally, for the broader market, the investors, the institutions deploying capital, the regulatory environment in Dubai is aggressively engineering a bankruptcy remote ecosystem for you.
That's the ultimate goal.
By legally prohibiting commingling and rehypothecation, the regulations are specifically designed to ensure that if a platform suffers a catastrophic operational failure, your capital survives the blast radius.
It's a massive win for consumer protection.
But analyzing this entire architecture leaves us with a profound unresolved tension, doesn't it?
It definitely does.
VARA has effectively deputized Dubai institutions to enforce global FATF standards via the Sunrise protocols. They have literally mandated that if a DAO cannot prove its human ultimate beneficial owners, it is effectively barred from the regulated financial system.
And this raises an important question, something for everyone to really ponder.
You hear it.
As these institutional-grade compliance mechanisms,
Yeah.
Enforced identity, mandated tracking, absolute mathematical transparency as they become the gold standard for global capital, will the foundational ethos of crypto survive?
The total anonymity and decentralization.
Right. Does that cypherpunk vision of Web3 survive? Or are we simply witnessing the inevitable, necessary merger of traditional banking safety with cryptographic speed?
I mean, the code may still be immutable, but compliance is now the law.
Very well said.
Thank you so much for joining us as we unpacked the mechanics of the future of finance. Keep pushing boundaries, keep questioning the consensus, and we will see you on the next deep dive.